Hello, my name is Manuel Ramos, Francia, and I am the Director General of the Center for Latin American Monetary Studies. Today I'm here with you for the digital launching of the Latin American Journal of Central Banking. I think it would be fair to say that in the last few years, central banks have gone and undergone through a lot. During the global financial crisis and its wake, monetary policy had mainly two goals. First, financial market stabilization, and second, to put in place an unprecedented amount of monetary accommodation. In the first case, it is well known that for different reasons, as uncertainty increased dramatically, counterparty risk followed suit. Indeed, markets froze as participants hoarded liquidity, even triggering asset fire sales. Policymakers had to learn very quickly that, if conditions of intense systemic stress arise, bad equilibria can materialize very rapidly. Under these circumstances, central banks reacted by providing all necessary liquidity to ensure that markets continue to function. They did this through various means, from relaxing collateral standards to creating different facilities to ease liquidity provision. Indeed, these actions range from central banks acting as a market maker of last resort to using their attributions as lenders of last resort, if they so deemed it necessary. In the second case, unprecedented monetary accommodation was put in place mainly through forward guidance and quantitative easing. Hand in hand with monetary policy entering uncharted waters, financial stability issues came to the fore, gaining enormous importance. Extremely low or zero interest rates can lead to excessive leverage and risk-taking. In this context, important vulnerabilities can arise depending on the degree of interconnectedness in the financial system. Central banks, as well as other financial authorities, and certainly academia, had to gain a clearer and keener understanding of systemic risk. To do so, it was essential to define more accurately what systemic risk was, so as to analyze it, model it, and basically create a whole new area of policy aimed at achieving financial stability. Issues such as too big and/or too interconnected to fail, the legal entity identifier, liquidity ratios, bail-ins, central counterparties, and so on, became the focus of an international effort to better regulate and supervise the financial system. Many of the problems that gave rise to the global financial crisis, as well as many of the policy responses, brought to the fore many other important issues, as well as the need to take further action. In some cases, it basically turned out to be almost a process of learning by doing, presenting continuous challenges to policy making and academia. Let me list some of them. A first topic relevant mainly for advanced economies, central banks, although with important repercussions for emerging market economies, has been the issue of the zero lower bound and/or of negative interest rates. In this case, there has been a lively debate on whether the largest advanced economies find themselves in a situation of secular stagnation, thus leading to a very low natural interest rates. In that case, low central bank reference rates would be reflective of low natural, in effect, real rates, as would be a relatively flat yield curve anchored at low levels for interest rates. Indeed, various studies suggest that advanced economies' natural rates have been trending down for several decades. Moreover, information extracted from surveys and market instruments, for example, inflation and/or interest rate swaps, clearly points to expectations of low inflation and/or interest rates over quite a long time horizon. Persistently low interest rates in advanced economies can be problematic in terms of leveraging decisions by firms and individuals, risk-taking, and in general asset valuation, all of it potentially leading to financial instability. In this context, extremely and persistently accommodative monetary policy, think of low for long, and financial stability issues would seem to be, at times, closely intertwined. The previous point consequently led to a debate about how and who should be mainly in charge of macroprudential policymaking and the overall monitoring and vigilance of the financial system stability. What entity or entities should be in charge and what governance should it or they have? An important topic of discussion has been whether quantitative easing blurred the line between monetary and fiscal policies. In this context, there has also been a discussion on whether EMEs can afford to implement quantitative easing policies, as many have not too distant histories of high unstable inflation, some even of hyperinflation, due to deficit monetization and fiscal dominance. There is little doubt that central banks played a dominant, if not crucial, role in macroeconomic stabilization after the global financial crisis erupted, so much so that they were deemed by many to be the only game in town. This even gave rise to questions such as whether such economically powerful institutions should be headed by unelected officials. Extraordinarily accommodative monetary policy on the part of advanced economies has important spillovers on emerging market economies, as the exchange rate is an important channel of transmission. This led to a vivid debate on whether quantitative easing amounted to competitive easing, with much talk about the possibility of currency wars taking place. Indeed, a beggar-than-neighbor type of equilibrium for global growth would be quite inefficient. Also, it led to a discussion concerning the possibility of improving the current international monetary system, or non-system as some call it. Persistently low interest rates in advanced economies have contributed significantly to increased capital flows to emerging market economies. After the episode called taper tantrum, volatility of capital flows to EMEs also increased markedly. For various reasons, all of this has posed an important challenge to macroeconomic stabilization and management in emerging market economies. Concerning this last point, a debate ensued about the difficulties for monetary independence in emerging market economies, even with floating exchange rate regimes in the face of unconventional monetary policies in advanced economies. It led to some suggesting that it was not really a question of a trilemma, recall the Holy Trinity debate, but of a dilemma for EMEs when a global financial cycle is present. The dilemma would mainly refer to the possible incompatibility for monetary independence of having an open capital account and a floating exchange rate regime in the presence of a global financial cycle. In this context, a whole new discussion on the need for capital controls in emerging market economies also took place. On the other hand, new regulation and rules, such as the one called the Volcker Rule, dramatically changed the main players in emerging economies' financial markets. Whereas before the global financial crisis they used to be banks, afterwards global asset managing companies gained in importance. The nature of global asset managing companies is quite different than that of banks. Firstly, they are mainly unleveraged. Second, they face a different structure of incentives on how to operate. The latter can be thought of as a chain of principal-agent relationships, where the main monitoring instrument is the yield global asset managing companies obtain relative to their competitors. They are thus characterized by an aversion to ranking last. Additionally, the market for asset managing is highly competitive and presents a high rate of attrition. The nature of both global asset managing companies and, more generally, of the market for asset managing, together with near-zero interest rates in advanced economies and relatively higher interest rates in emerging market economies, has contributed to the presence of herd-like type behavior and thus of high capital flow volatility in emerging economies' financial markets. All of the above can be circumscribed as a global monetary game where investors, asset managers, and central banks, both in the core country and in EMEs, are the players. In effect, equilibria in these games can result in herd-like type behavior. In addition to new players gaining prominence in financial markets, new ways to operate have also become predominant. Algorithmic trading, high-frequency trading, and others are now more prevalent. Most trading is now done through automated electronic platforms. By now, it is well established that algo trading and the like are intense demanders for liquidity, whereas algorithmic provided liquidity dries up very quickly in times of stress. For this and other reasons, liquidity risk has become at times quite significant in most emerging economies' financial markets. As a result from the spillovers of the so-called unconventional monetary policies, the appearance of new players and of new technology-intense ways to operate, as well as for a myriad of other reasons, central banks' coordination has become quite necessary. Central banks' bilateral funding agreements, and perhaps most importantly for EMEs, dollar swap lines, can become essential elements for macroeconomic stabilization. The pace of financial innovation has been neck-breaking, so much so that the so-called fintech firms have been transforming the financial services industry, which could have a profound impact on traditional banks. This has led to the need to regulate and supervise them properly. Clearly, it can also have an impact on monetary policy transmission. A related topic has been the analysis of the benefits and costs of central bank digital currencies. Evidently, the above has brought to the fore cybersecurity, and more generally the need to better understand the different risks to the financial system stability arising from financial innovation as well as the system's increased complexity. Many mathematical and/or statistical tools have been used to analyze different aspects of financial stability. Financial network analysis deserves special mention. This tool has been used quite successfully to better understand different aspects of the financial system's interconnectivity and the vulnerabilities to the system derived thereof. Adding macroprudential policies to the policy toolkit has at times given rise to the question of whether monetary or macroprudential policies should be used to address certain problems, where monetary policy can at times be considered too blunt an instrument. In the last couple of years, the repo market in the US has been affected by problems that have rendered it, on occasion, quite illiquid. The US Federal Reserve reacted by providing the necessary liquidity to keep it functioning properly. Other examples of timely liquidity provision have been implemented by various EME central banks in the case of their FX markets. In the last few years, there has been special interest in green finance, in topics related to climate change and financial stability, and, in general, in how various central banks are modifying their monetary policy frameworks to incorporate climate change. The current COVID-19 pandemic is clearly a shock to public health. Thus, it entails mainly public health and fiscal policies as a response. However, monetary policy has played an important role as well. Firstly, through the assurance by various central banks that they would be providing whatever liquidity was necessary for markets to keep functioning, since at times the associated uncertainty put a lot of stress on the financial system. Second, through trying to ease access to credit to small and medium-sized firms, in some cases through facilities that these firms could access directly. Two things concerning the latter facilities are worth noting. First, designing an appropriate structure of incentives for these loans is not trivial. And second, there have been important calls to supervise that these resources are directed appropriately to those firms that are targeted. Thirdly, this time around, some central banks have also tried to wield yield control more than QE. As can be appreciated, since the global financial crisis, central banks have acted and reacted assertively and in a timely way to various challenges, displaying lessons learned during and after it. Monetary policy is in a constant state of flux, not only from enhanced knowledge coming from theory, empirics, and practice, but I will say mainly from the different challenges that arise in an intricate, highly integrated, globalized, and each time more technologically advanced world. The same goes for macroprudential policies, where many times the biggest challenges come from where you least expect them. EMEs, in addition, face further ones. In these economies, institutions are not as strong, financial markets are less deep, they have much more complicated economic histories, and certainly they don't possess reserve currencies. Macroeconomic management is thus much more complicated. At the Latin American Journal of Central Banking, we believe that many of the topics that I mentioned, and many others, are ripe for taking them to the next level of understanding and analysis, and that the pace for new developments will continue to be very rapid. This, in combination with the vast amount of human capital that exists in central banks, in other financial institutions, and in academia, suggests that the time is right for a journal like the Latin American Journal of Central Banking. The advisory board, the co-editors, associate editors, and I will certainly try our hardest to make this a successful story. Thank you very much.